everybody. My name is Sue Slocum, and I'm the CIO of Children's Minnesota, Pediatric Healthcare System in Minnesota. I'm here to introduce, I'm going to have each panelist introduce themselves. If you would also add maybe a comment about your AUM, if you would, of your kind of primary portfolio, and then how much private equity is part of your allocation, and then maybe one personal fact about yourself.
Okay. Wasn't prepared for that last one, but no problem. My name is Tina Surh, and I run a large portfolio for a very large established single-family office based in New York City and Palm Beach. I will decline to share our AUM because in dynastic families we don't do that. But I will share that we have roughly 37% of our portfolio in illiquid assets, and within that, it's a high single-digit percentage in early stage investing. When I think about kind of the build out of where that is now, it's a global multi-asset class portfolio, and my own background includes direct investing, capital allocation, board rules, et cetera. But I actually identify most with designers and makers and problem solvers. So maybe that counts as my personal tidbit.
Certainly.
My name is Stuart Mason. I'm the Chief Investment Officer at the University of Minnesota. I manage an endowment of $1.5 billion, and my office also manages other university assets. We have, I think to date, 48 or 49% of our endowment pool is in illiquid assets of some sort across all asset classes. Somewhat uniquely, almost half of that 48% would be in venture, largely in early stage venture. I think for a comment about myself, I race sailboats.
And you usually wear a bow tie.
I usually wear a bow tie.
Okay. All right. Richard?
Good morning. I'm Richard Gardiner, Chief Investment Officer of the Johnson Company. We are a single-family office set up in the 1970s by Robert Wood Johnson IV, who was a great-grandson of one of the founders of Johnson & Johnson. The Johnson family, also established in the 1970s the Robert Wood Johnson Foundation, but that has evolved into an entirely separate organization, different portfolio, different investment team, and in fact, the Chief Investment Officer is here at this conference and speaking on one of the panels this afternoon, Brian O'Neill. I see him out there. Personal comment about myself, rather than sailing, I prefer running, and last serious race I ran in was Beta Breakers here.
Ooh, great.
Good morning, my name is Mark Cutis. I'm probably the only corporate person here. I'm the Chief Financial Officer of the Abu Dhabi National Oil Company, which is the second largest oil company in the Middle East. We produce 3.5 million barrels of oil a day. I spent my entire life in investments, risk-taking. And in this capacity, I'm focused a lot on bringing private capital into our main activities, which I think kind of embellishes a lot of what we would do by bringing a different perspective as opposed to the large company format. Prior to that, I was the Chief Investment Officer at the Abu Dhabi Investment Council and had set up this vehicle that was focused on special situations, and we have a 11-year track record in this arena. In terms of a personal tidbit, I've spent most of my life outside of the US. I've lived and worked obviously in the Middle East now for over 10 plus years, the UK for 14 years, Japan for 7, Moscow actually at one point, Frankfurt, and of course New York. Thank you.
Hi, I'm Marcus Frampton. I'm CIO at Alaska Permanent Fund. We're a $65 billion oil fund for the state of Alaska. We've got about 12% of the funds in private equity and venture capital. But when you add in real estate and private credit, hedge funds and infrastructure, kind of these alternatives are about 45% of the fund. On the personal side, I'll tie it in kind of to the topic of the panel. I've been for a number of years kind of a perma bear, and I've always been wrong. And I don't know if it's because the financial crisis was such a bad event in my life, or I read too much Grant's Interest Rate Observer, but I've always been kind of a perma-bear. And a couple years ago, it dawned on me that it was not helping me at all to always be negative, and I need to like embrace that, growth and equity risk and these things. And so I'm at a very confused point in my career because I'm realizing I need to be more positive, and then now we have panels on late cycle, and everyone thinks we're in the late cycle. So this should be like my moment, but if some of my comments on this panel are contradictory or confused, that's the driver of it.
I'm Bob Jacksha. I'm the Chief Investment Officer for the New Mexico Educational Retirement Board. About $13 billion in assets. We serve roughly 120,000 people who are in the educational system, both K through 12, teachers, custodians, the lunch lady, all of the educational employees. We have about 15% of our portfolio in private equity and venture, mostly in private equity. And overall in alternatives, we're probably nearing 60% now. One fact about myself, I lived in Salt Lake City for a couple of years. You may not know this, but that's a prime training area for hang gliding and paragliding. I am one written test short of being licensed in paragliding.
All right. Well, with that, we will need wings, I think, to take on this next question, which really is, can you give us some insights into what your return strategies are today, given what many are considering really a late market cycle? Tina?
Okay. I think, so the indicators are that it looks like a late cycle. The problem is that we don't know how long the lateness can persist and how far a rubber band can stretch. And so from a coping mechanism or a strategy standpoint, I'd say, it's really about thinking like an owner as opposed to an agent, and having a lot of humility around risk. So that then implies really trying to condition the folks, the stakeholders, to resist temptations of like FOMO, kind of senses, and to be disciplined around maintaining what feels like an appropriate balance of participation, right, in risk-seeking activities with flexibility and liquidity, and really lengthening our horizon, because I think it's a fool's errand to think that you can trade around market volatility, and with private capital and no spotlight, we can actually behave in ways that really are much more aligned with ownership.
Stuart?
I think late cycle investing is in every conversation we have within the office, and to leverage a little bit of what Tina said about participating in risk, we are almost every week reconsidering what kind of risks can continue to produce decent returns in either flat markets or down markets that will eventually come. And while we don't want to take risk off the table in anticipation of recessionary periods and so forth, I think we're doing everything we can to shift our risk profile. And for us, that for the last couple of years has meant much more in higher yielding structured credit with fundamental asset values underneath and guarantees or things like that. So we're shifting more into that sort of structure rather than long only equity or adding to our private equity.
Richard?
Yeah. Personally, I think we have a lot of problems that go beyond even late cycle problems. So I'm a little bit like you, Marcus, in the sense that I'm almost a perma-bear. I actually think stagflation is a potential outcome, given that tariffs are likely to raise prices and slow growth. But by way of a little bit longer explanation, I think a big part of my job and a big part of my fellow panelists' job is to always think and worry about what could go wrong in a portfolio. There's a saying out there that equity investors like to be optimists and see the glasses half full, and bond investors are trained to be pessimists and see the glasses half empty. I started my career in convertible bonds. And convertible bond investors, there's an inside joke that we have been trained, because the companies that issue convertibles, including WorldCom, Enron, and Lehman Brothers, we've been trained to look at a glass and see it as half empty and poisoned. So whenever we had this panel, I'd probably talk about things that could go wrong, but to the question, we are not changing any of the risk profile in our portfolio for a couple of key reasons. We just don't think anyone can accurately predict economic cycles with any degree of consistency, including entities with limitless budgets and proprietary information. And even if you could make some predictions about specific things such as jobs growth, inflation, or even specific events, the market is truly humbling in that it will often act completely unexpectedly. The best example of that today is the mess with Brexit. Brexit was unquestionably seen as a negative event for US equities around the world. But remarkably, equities around the world actually rallied after the leave vote in June. You can see that. That includes the UK market in dollar terms. If you look at the UK market in dollar terms, the UK market actually rallied through the end of 2016. It was up 5%. And to date, despite the fact that Brexit has cost actually 2 prime ministers their jobs, the UK market in dollar terms is still up over 20%. And the US market, the S&P, is up over double that. So our general view is that trying to time risk in a portfolio is going to hamper your portfolio, and that the rewards generally weigh to your advantage if you stay invested according to your strategic asset allocation.
Mark?
So I would argue that I take all these points on board. In a way, I'm actually comforted that the perma-bears are concerned about being perma-bears, because I would argue that we're in for one enormous big shock that's coming on the horizon, and it's probably going to be closer to 2020. And if you think about the accumulation of things that have been going on, you have record low interest rates. And for those of you who look at cycles, interest rates peaked in 1981. We've been going down essentially for 35 years, which is really, if you look historically, that's typically the time frame that you have these major movements. So you've had, lows have been put in interest rates, and from here on out, not immediately, but over time, rates are going to go up. Equity markets are at record valuations. And on top of it, what's changed fundamentally today is that the geopolitical arena is different. Now, we tend to talk more about what's happening in politics than we ever did before. None of it is positive. None of it is positive. And I say that as an American who's lived most of his life overseas. At one level, we have become a source of volatility for the rest of the world. And none of this stuff, comes out at the end in a positive way. A lot of you in the audience might say, well, yeah, we've heard this before, but it doesn't matter because technology will win. I'm not sure. We're potentially headed for some difficult times, and I would argue that we have floated on a sea of liquidity for a very long period. And at some point, as this liquidity is withdrawn from the markets, it's going to be disruptive. So make no mistake, for those of you who think that you're going to have lower rates for longer, it doesn't happen. And I go back to the famous economist, Hyman Minsky, who talked about stability breeds instability. So if you're a prudent manager, in my mind, you should have some cash. Set aside, if you're concerned that your board of trustees, and Kim was talking about how boards of trustees kind of oversee, and they look at historical numbers. If, of course, they say to you, we don't care about those sort of like outlandish views, and you must meet you must meet your benchmark, that's fine. But make sure that you're protected and that you've explained to your boards that we live in a very uncertain period. You have heightened volatility, you have record low interest rates, and equity market valuations are at record highs. So it would be a miracle for nothing to go wrong. And next year, if we think about 2020, from 2009, which was the low in the market, that's 11 years. So in my mind, next year is going to be the big year. Between now and year end, I think you're actually going to see the markets will be buoyant because you'll have people will breathe a sigh of relief. We've engendered a lot of fear with all these things that we've been doing, and to the outside world. I think that stuff temporarily goes away, but it comes back to haunt us next year. So now maybe I'm the permanent bear.
Can I actually just build on that? And, so I know we're going to keep going down the line here, but I think discussions are maybe a little bit more fun. And I don't want to completely challenge the notion that rates will rise and so on, but I want to introduce the concern of our collective tolerance and capacity for the pain associated with that kind of an outcome. We want rates to rise so that we can deflate the tires again. And I think we're at an unprecedented, somewhat terrifying, kind of moment in history, not unprecedented in all of human history, in kind of the history of fiat currency and experimentation, but certainly in our lifetimes. And what's really troubling, and I ponder, are things that are indicative of where the policymakers' minds are at and the influence that they have on politicians, right? Because if you start to read like Brookings Institute papers or IMF papers and kind of the wonk kind of literature, what you'll find spelled out clear as day is celebration of the use of negative rates, right? And we see where that is in Europe and how persistent that is. And literally the groundwork for implementation of negative rates here in the US. There are folks who think that is just, it's like sacrilege, but I would say look at the data and it's actually there. The groundwork is being laid for the use of negative nominal rates, not real, nominal rates in the US. So my question is, gosh, how much pain will policymakers and politicians in a rising populist, kind of environment be able to withstand before they actually exercise that option? And the perversity is that actually is massively stimulative for financial assets, right? And then continues to beget the issues around sharing, right, of those gains between labor and capital. So it's, and I love Jim Grant, and you guys all know, because you heard me talk about my crush, my investment crush is Charlie Munger, right? So I am all about not doing idiotic things and trying to live a long time. But I'm not sure, we're going to see significantly greater rates, because when you think about where the bond vigilante is going to come from, and you think about the symbiotic relationship we have with China, right? It's a very different environment.
Well, the Fed, I think, shown that, this January that they'll lower rates and they'll be accommodative. And, I think with the elimination of the zero lower bound, to your point, there's a lot of room to go. And it seems to me like inflation is their Achilles heel. And, to me, that the question it raises for our portfolio is like fixed income. If inflation is the Achilles heel and they would have to react, with raising rates at that point, unlevered real estate is a better asset for that eventuality. And then for me, I've seen just like creeping risk in all of our areas. So when I came to the permanent fund 7 years ago, we owned very high quality unlevered real estate, Class A, and then there's a temptation to invest in a private equity real estate fund that's doing a lot of development, and then we've over the years added some leverage to our portfolio, and at some point your control of the portfolio changes and your ability to access liquidity from it changes, and so I'm trying to on the margin de-risk within asset classes, like in hedge funds, market neutral instead of the long short, long 40% stuff. And then I agree with what Richard said about like it is very humbling to try to particularly when you're operating from Juneau, Alaska, with a very small team to see around the corner. But one thing I've noticed is people change their asset allocation so frequently that it almost becomes tactical, and it's the consistent, like, more equity, less fixed income, and that's been the progression for us and for pension funds that try to hit an 8% return. 20 years ago, you could do that with a 50% bond portfolio, and so everyone's moving in this one direction. So for me, it seems like such an unstoppable trend that even if you just hold the line, or if the board wants to increase risky asset classes by 2%, take that from public equities and increase fixed income, has been kind of like the on the margin, the things you can do. But I think inflation could be the real risk because the Fed couldn't react, but hard to have a crystal ball on it.
Can I just jump in? The assumption that negative rates can work and prevail is a spurious one, I think. Because just think about it, just from the standpoint, if everyone knows something and it's widely accepted, then what's the value of that information? So the assumption that equities will always go up and that rates will not go up, if that is embedded in our collective imagination, how likely is that to prevail? What we don't know in investment land is timing. And this concept of the rubber band, I think someone else mentioned before, rubber band opening or closing. That's fine, and people are uncomfortable with the concept of market timing. Okay, but it doesn't mean the market will reward the consensus. That's a crazy idea. If you think about finance, unlike medicine or technology, the market machine is mean reverting, right? You get these expansions and you get these contractions. Technology over time improves. I mean, if you just look at your phone, it's very different from what it was 5, 6, 7, 8 years ago. If you think about kind of normal surgery today versus 10 years ago, all that stuff has changed. Nothing is new under the sun in finance. The only thing that's new today is that people are very excited and they've returned to putting more equity. It wasn't that long ago when we watched people in 2008, 2009, 2010 who told their GPs, don't call us with any drawdowns because we don't have money. And now everyone has gone back to, I need more private capital. So let this kind of resonate a little bit. Just think about it, because the next shock, which will happen, and that's the only thing we know for sure, if anything is to compare what happened 2009, 2010, it's going to be a doozy. And to assume that the policymakers can just press a magic button, that's a big statement to make.
Well, actually, just to clarify in case it was not clear, I think that the prospect of that is terrifying. Right? I am not endorsing actually that, but I don't think that, I don't have a lot of confidence in the will to behave more like an Austrian, right? Kind of around these issues. And so, we're gonna have to figure out how to navigate through that ride. But I think that the complacency that you're talking about is really important to avoid, and that's why I wanted to flag it, because I think you're right. I think there is a lot of complacency that, oh, well, that can just keep working. And the problem is it just, kind of keeps deepening the nature of the problem itself, right?
Bob, you have thoughts?
Well, just to talk about negative rates, I think they certainly haven't worked as well as the central banks had anticipated, negative nominal. And there's evidence that they have not stimulated the behavior that they wanted to, and in some cases it was the opposite. So personally, I think negative rates are crazy, but nonetheless, Yeah, on the low rates, Marcus, you touched on what the Fed did in January, which just, you think about it, what caused them to do that? I mean, we didn't have really bad economic numbers. Yes, the markets were trending downward, and then they said, oh, no, never mind, we're not going to keep going with that. I found it quite surprising in any case. You know, Mark, you're right, we'll have some kind of a disruption somewhere. We obviously don't know what it is, or we'd all be prepared for it, and then it wouldn't hurt. But it is challenging. Now, having said that, I guess I'll get back to the original question and frame this that as a public pension fund, we're somewhat moderately underfunded. We're not Kentucky or Illinois or anything. It's not a huge issue. But because we are underfunded, we don't want to take another large shock in our asset values. That's a problem for us. On the other hand, we have to earn, per our actuarial projections, 7.25% per year on average. So we just have to earn a lot of money and not take any losses. Very simple.
Yep, a unicorn. Yes.
Pardon?
A unicorn? A unicorn?
Yes,
strategy?
thank
Yep.
you. So actually, I've been there 12 years now, and the approach we've taken is, I guess I'd say, to kind of try to thread the needle, to build a very diverse portfolio that has risk factors that are not as focused. We're not focused on public equity markets as they used to be. We were a 70-30 equity bond portfolio. As I mentioned, we now have more than half the fund in alternatives. And we're following a strategic asset allocation that we do not change much over time. We look at it every 3 years. Our last effort, which is sort of related to us being in the late cycle, which we may stay in for quite a while, Tina, as you mentioned, is that we have another asset category that we are simply calling diversifying assets, which we want assets that are not correlated or very, very lightly correlated to public equity markets in particular, and that also give us a return that is additive to the 7.25%. We've done things like reinsurance. We're looking at aircraft leasing, a number of other things I sort of think of as alternatives.
All right, so picking up from that, what are the challenges and what are the opportunities that you're working on, kind of given this background of more volatile markets anticipated? Can you share?
Well,
Tina, or
You go
Stuart.
first.
You know, I said a little bit earlier, we were migrating more towards structured credit. We, similar to what Bob has just mentioned, our asset allocation over the last several years has been simplified to be equity beta oriented growth strategies, which is almost 65% of our portfolio. So it's one bucket where public and private equity oriented assets all compete for the same capital allocation. 30% diversifiers, where there's a very, very low correlation to equity beta, and then cash and treasuries. And I think we've spent most of our time in thinking about how that diversifiers bucket can be built in a manner or constructed in a manner that addresses the need for return. So it's not all, neutral hedge funds and so forth. It's 6, 7, 8% at a minimum kind of returns, but in low equity beta strategies. And that's where the structured credit that we've been doing a lot of, go where the banks don't go, or, find credit related opportunities that are more niche in their orientation. We've also looked at reinsurance and litigation finance and royalties and a variety of different things that generate a return that is pretty independent from equity markets. So,
Any others want to add? Richard?
So the two questions, I think, were in that last one. What's the biggest challenge and where do we see opportunity? So I think by far the biggest addressable challenge is knowing what you're trying to accomplish with the portfolio, with your capital. The investment team and the investment committee absolutely has to agree on what the purpose is of the capital, what goals you're trying to accomplish, and the plans to achieve those goals. Of course, you're going to alternate your goals, adjust them based on conditions, based on the team, based on managers, but you need to have, at a minimum, a strategic asset allocation. Otherwise, you're just going to get whipsawed. I mean, you can see that in the conversation here. There's always something to think about, always something to worry about, and you just don't want to be fighting yourself. Otherwise, in a moment of decision, you're not going to be able to react calmly and decisively. You're just going to get whipsawed. And I mean, what happened between the fourth quarter and the first quarter this year was a perfect example, where the fourth quarter there was a 20% drawdown. It was very difficult at the time of that 20% drawdown to calmly allocate more money to equities when in fact that would have been the right thing to do if you're trying to keep the strategic allocation. In terms of opportunities, in general, you've probably picked up from my comments that we look to areas that aren't going to be as vulnerable to economic cycles. That's one of the first things we look towards. The other thing we look towards in general is areas that really benefit specialists. We have a healthy skepticism of the degree to which it's difficult to beat passive index exposure for active managers. And one of the areas we think that there's a great opportunity to do that now is in healthcare, because of all the things that are going on in healthcare. Healthcare, some of you may be following that, it is absolutely remarkable, the explosions and advancements across all areas of healthcare, different areas of science, academia, technology, and business. Traditionally, basically the primary form of medicine was small molecule medicine. That is gone by the wayside. I mean, you're now able to deliver traditional medicine through nanoparticles. Companies are developing immunology. There's even greater advancements. Someone mentioned CRISPR in gene therapy, cell therapy. The advances in science are changing actually the way you really think about life itself. All of these advancements are coming at the same time. You actually have a very constructive regulatory backdrop. In 2012, the FDA passed the Breakthrough Act, which awarded expedite approval to drugs which create breakthrough treatment programs for people with life-threatening illnesses. And I think a little over 20% of drugs that were awarded approvals last year were actually given this breakthrough status. So you're having all these constructive developments at the same time that there's actually a great amount of pressure on big healthcare companies to go out and spend money on new drugs because of the pressure put upon them by the payers. And you may have seen this, filling your own prescriptions. Insurance companies and government regulators are not paying as much on these Me Too drugs. In order to get reimbursement, drugs really have to be a breakthrough type of drug. So for all these reasons, it's really constructive for opportunities, commercial opportunities in healthcare, not to mention just two other factors that we think about. The first is that our office does not have a specific ESG mandate. We think that's very difficult to accomplish, although we certainly like to do the right thing. And healthcare is an area that you really can feel good about the investments you're making and how it's improving people's lives. But ultimately, actually, and maybe just as importantly on the investment level, you can pick where you want to be in the risk-return spectrum. If you're willing to take risk, there's certainly truly, in some cases, binary risk on the venture front, but you can dial back that risk for slightly lower returns across later stage private equity, public equities, and ultimately, if you're very risk averse, you can look for uncorrelated bond-like payments on mature drugs and pharmaceutical payments. So for all these reasons, we think healthcare is a very interesting opportunity right now.
I would agree with that, and actually I've been disproportionately spending a lot of time in healthcare, biotech, and in the really, really early stage stuff, that's specifically the intersection of life sciences and data science, and all the way through, I'd say, diagnostics and so on. And that's one kind of really important theme or sub-theme within one of my, I'd say, kind of three major themes as I think about being positioned as a risk taker for the next couple decades, right? Because number one, you're right. I think you have to choose how much risk you really want and need. Now, in our portfolio, we have a combination of taxable and tax-exempt assets, but our overall stance is frankly a lot less equity beta sensitive than I think is typical for many institutional portfolios. Most institutional portfolios are running with these like 0.7 to 0.9 kind of equity beta type portfolios. We're running probably around 0.4 in terms of how it all comes together. But the three big themes as I think about the long term and organize, kind of where I want to spend my time and take risk. One is technological innovation. And you touched on something that I think is really important, that if you just take what's going on in life sciences, right, and you think about genomics and then what's going to be possible as we gather more data and they're actually able to analyze that and actually able to start customizing things more and more, and the way it will ripple across not just human healthcare, right, but the food industry, for example, or really kind of a lot of manufacturing as we think about basic material science, right? There's a massive, kind of amount of transformation occurring. So overall, technological innovation and the way that will play out across pretty much every sector, right, in terms of the new entrants that enables, the adaptive strategies or capacity of incumbents, is really, kind of my first dominant theme. Second is secular growth in Asia. It's real, right? I mean, the demographics do not lie, right? When you think about getting things right, I am so excited to be able to own Kotak Mahindra, right? I mean, look at that, just look at that enterprise. Clean balance sheet, right? It's compounding, it's growing and compounding, 20% a year, and with a really long runway. In the last 2 years, I think in India, something like 250 million bank accounts, deposit bank accounts, has been created, right? That is just really powerful stuff when you think about the magic that is compounding, right? And then the third really is something that we were, kind of circling around before, which is just the implications of monetary policy experimentation that I think is going to continue to be with us for a long time because of just the scale that sovereign balance sheets have gotten to, and kind of the tensions around that. So, in terms of picking your spots and right, kind of choosing where to take risk and where to take out risk. I think being really, really deliberate about specific assets and really as bottom up as you can be, so that you can withstand, right, kind of the machinations of the markets is important. Simply being a value investor, the way that value investors have been rewarded, for mean reversion, I think that's not going to work out.
Mark, do you have some thoughts?
Yeah, so I have a challenge because our fund's very large, 65 billion, so you have to kind of pick your spots. And then, a lot of what we do is manager selection and sort of delegating that opportunity sourcing to those people. But I think that, so in areas where there's big amounts of money to put to work that are, at an interesting entry point, they're fewer and far between. You end up with your bat on your shoulder a lot. But we're fortunate we have the flexibility to do some interesting things. Like in the financial crisis, our CIO at the time bought close to $1 billion worth of foreclosed homes at auction and put together a REIT that's now public, American Homes for Rent. And that was a great investment. I think reinsurance is interesting. Like that's on a completely different cycle and pricing has improved. I mean, I haven't reached a conclusion on it, but that's an area where you can put some real money to work that's not at all-time highs. The energy industry is at a tough spot right now. Alaska itself has been in a recession for 3 years, and there's actually some really interesting development activity in the north of the state, and it can get political, but Anwar's now open for exploration, and there's some areas being accessed with everyone thinks of new technology in oil and gas and the shale, but some of that's developing some interesting things in the state. And we're a big owner of real estate directly, like in Houston. That is a tough market right now. If you're an expert in oil services, there's a lot of unprofitable companies. So those are areas to hunt. I'm not sure if it's the time yet to go in there. Financial services, I think, in the interest rate environment we've been in, it's been a tough time to be an investor in banks, regional banks, and then broker dealers that can earn a spread in the past haven't recently. And it's also for like the venture side, just an area just so ripe for disruption. The money that the traditional banking system that still exists, it takes out of every transaction. And Facebook just came out with the Libra coin this week. I think I don't know the answer on how it's going to get disrupted, but fintech venture is a really interesting area, I think, and financials and energy are not riding high like tech and consumer products are right now. So there's interesting areas to look.
Bob?
Well, our biggest challenge for everybody is that predictions are hard, especially when they're about the future. So I think that's a Yogi Berra quote. So in any case, really the challenge is that the opportunities are not what they used to be because of, Tina and I were talking earlier, all the, as she put it, free money that's out there. It has to flow somewhere. It's flowed into a lot of things that are in the alternative space. Stuart mentioned structured credit and opportunities around the banking system. That's something we've been doing since 2009. And there are still pockets of opportunity, but in 2009 and 10, you could almost throw a dart. And we got equity-like returns for credit-type risk. That's not there anymore. One particular area with banks is we do have a manager that specializes in what I would call relieving banks of their regulatory burden on their capital through various structures that they do. So you can still get reasonable returns with not outrageous risk because the banks are motivated by regulation. We love trades like that or strategies like that when we can find them. There are not a lot of them. There is another one we're doing that's really off the beam called mitigation banking, where there are wetlands regulations for, let's say you want to build a shopping mall. Well, then you have to offset if you're filling in a wetland. And we have a manager that does large projects and sells credits, which is much more efficient for the developers, because if they do it, it costs them a lot more. So again, the regulations cause somewhat of a mismatch there. So there are some pockets of opportunity. We've also done some drug royalties. We think there's opportunity there as well.
We have a lot of music royalties. Yeah.
We haven't done music yet, but that we're looking at music, movie, entertainment.
So just to jump in, all these are idiosyncratic transactions.
Yes.
And because I was doing for 10 years special situations, litigation finance, regulatory capital relief, reinsurance, drug royalties, music royalties, we did all of them. The trick there is to be slightly ahead of the crowd, slightly ahead, and to do it with the right people. That's the whole governance thing. That's the alpha equation. That is not going to save you. Just want to make sure everyone understands that. That's not going to save you. Everyone in the audience should ask themselves a very key question. Hey, imagine if that guy up on the audience is, up on the chair is right, and we go through a very difficult period, and the market's down 25%. Will we be able to add to our portfolio? What will our governance, what will the people who sit above, what will they say? 9 times out of 10, they'll say to you, whoa, let's wait. Let's wait. So, but go through the exercise now. And if you have enlightened overseers who will completely understand and say, hey, now the market dropped 30%, now we got to go in with a big shovel, shoot it in, back up the truck, all those other silly expressions that people use, then you're okay. But if it's not the case, and if people will say, hey, let's wait, it could get worse, then ask yourself what you should be doing. So what you should think about is if you have an overseer or group or person or whatever that is kind of a namby-pamby and is going to get frightened, maybe you need to raise a little bit of insurance, a little bit of excess liquidity just in case. If you don't have to worry about that, then you're in a completely different zip code and you're off scot-free.
Cash is beautiful. No, really, I was so excited a little over a year ago when we could reladder our cash portfolio and actually have just a little over a year duration on that and have it generate 2.5%, right? I mean, that was so exciting because cash actually has a value, which is the option value, right?
Sure.
And in the short term, people don't really appreciate how powerful it is to have that option and to be a provider of liquidity when other people cannot be a provider of liquidity. And it is, it's underrated and underappreciated, and it drags the return, right, in the short run. But in the long run, it is such a powerful tool. So I couldn't agree with you more. And in terms of the patience and setting the playbook, I think it's great to have that exercise of kind of discussion of, okay, let's think about like the next big dislocation and actually have that conversation. So what do we think we could do or might be interested in or whatever, so that you start to build in that emotional kind of response, because otherwise you're always chasing. So I think that's a really, really good point. And and in terms of capitalizing, it's possible, right? I mean, like when I got involved with Gruss and Martin Gruss, the patriarch of this family, I mean, he's a lifelong money manager. He's a risk arb, an event-driven investor, and there's actually a nice little chapter about him in a recently published book, but about risk arb, and but we have a lot of simpatico around the global kind of condition and some kind of humility around risk, and that. But a big difference is kind of our tolerances for some duration and emerging markets exposure. So when I first got involved, we had really like almost nothing, right, in much of Asia, for example. And in trying to build this out to a really significant part of the portfolio, in terms of the public part. I said, okay, we're gonna go slow here. We're gonna try to, kind of get kind of favorable entry points, and it's gonna be annoying and frustrating, kind of to see, periods that look like we're missing out as this thing is running. For example, in China, but we're gonna wait, and it was really actually gratifying coming into the fourth quarter because I said, okay, we're gonna go now. December, January, February. We're gonna spread it out over 3 months. We're gonna build up a lot in A shares because now look at just the empirical value of like what's happening at the specific 20 companies that we want to own, and so November comes around and the world is like freaking, and the patriarch and I are talking, and he's like, do you think should we just not do this? To your point, let's not. Right? Let's not. And I said, no, you know what? We have to. But I'll compromise. We'll cut December in half, right? So we'll do half as much in December. And, then we're able to kind of keep going with January, February, and then, nice big reward. That thing was up like 40% before March. So it just helps you on the way in if you can build that cushion. That's luck, right? But also some discipline.
So it underscores having a plan.
Exactly, right?
Yeah.
And not looking over your shoulder at what everybody else is doing, right?
So with that, I want to ask Bob, and we don't have a lot of time here, but all of you to answer this question. With respect to your venture capital exposure, is your foot remaining steady on the accelerator? Have you taken your foot off the accelerator? Have you put it on the brakes?
Yeah.
Where are you at? Bob?
We don't have a very large venture exposure as part of our private equity, so it's just been gradual, and we'll keep doing that.
So you're remaining the same?
Yeah.
Okay, Marcus?
Yeah, more or less the same answer. Yeah, I mean, we're committing $400 or $500 million a year to venture funds. One thing that has changed is we did make one investment in one of the and actually Sequoia's late stage fund, which there's a lot of debate internally about more growth equity later stage, but that's kind of been our one investment that was a response to this like fewer and fewer public companies, people waiting longer to go public, and time will tell how it does, but that was one change we made.
Mark?
A slightly convoluted response because we actually want to use venture in oil and gas to extend our reach. So as opposed to us as a large company making 5 investments, in which in our environment, large company, we tend to suffocate people. You actually bring in groups like Trusted Insight to help you so that you can make more investments, have a bigger portfolio, and ideally do more interesting things. So accelerator on.
All right. Richard?
We're keeping it largely the same, but the one distinction is we're really trying to reduce line items and consolidate mana relationships. This is one of my personal bugaboos. I think complexity is the killer of portfolio performance, and you really have to be disciplined on just how many managers you can add. There's always another new idea out there in venture, and you just can't approve all of them.
Stuart?
I think our attitude has always been venture is a great place to take advantage of disruption and innovation. We already have a very substantial venture portfolio, so I can't say that our foot is on the gas, but we are in a maintenance mode and recycling capital that we are receiving back from distributions back into the asset class.
Over the last few years, we've been shifting, de-emphasizing the late stage stuff, which has performed really well, and augmenting the earlier stage investments. So
Opportunities. All right.
so slightly, again, I'd say, it's not like trying to triple the amount that's there, but shifting. So, being willing to be really, really deliberate and targeted in really early stage stuff.
All right. Well, we have time for questions and answers. Any questions from the audience?
Just a comment. Sit down. Just a quick comment. So I manage the City of San Jose's pension plan, and like many pension plans, we are underfunded, but at the same time, we do have a target rate of return. And unfortunately, our boards de-risked after the Great Recession. And so we've been playing catch up since then, and now we are in an even bigger hole. So what do we do now, right? So last year, I convinced the boards, talking about cash is beautiful, to put 15% of the portfolio in treasury bills. And it has so much optionality. And when things correct, if we have the right governance structure in place, we will be able to re-risk our portfolios. At the same time, we balance that de-risking by increasing our venture exposure. And hopefully, we don't have the mark-to-market problems that public equity has. And hopefully over the long term, that'll actually pan out for us.
All right. Any other questions? Rick?
My comment is good luck.
Good luck.
We all need it.
Given right now we're in kind of late market cycle, do any of you use tail risk hedging strategies? And if you do, what kinds of strategies do you use?
Well, I'll say we do not use explicit tail risk hedging in terms of buying put protection. At times I've thought about selectively even buying call options. It's always seemed to me that the pricing could be more it could work out more favorably to think about, if you're really that worried, reduce your exposure, buy some call options, right? But the problem with like the options market is it's just, you tend to systematically overpay over time. So it doesn't have a lot of appeal for us.
Any others?
We looked at a strategy of buying puts when puts were cheap. They weren't cheap enough for us to do it, so we do not. Some of our individual managers, particularly in credit, do have some tail risk hedging. No, we don't.
We actually do at Children's, not so much tail risk hedging, but we do hedge some of our S&P, I guess, or equity beta exposure, which would be about 65. We hedge it down to about 42 on an ongoing basis. So we're not being tactical, we're just being trying to create an asymmetrical return structure to lower that bottom side risk. So.
The reality for most pension funds, for most traditional managers, is that there is too much complexity associated with derivatives, and derivatives historically have been viewed as dangerous. Therefore, to construct a case that the board will be comfortable with, which is to use a portion of your excess returns to buy some protection, is difficult. The reality is some people do it, they do it well, and they can benefit, because if you think about it, people will say, well, you know, option vol is high, I'm not going to pay for options. Fine, then you should be writing options. That's a little scary, right? Option vol is low, oh, I bought options. Then someone on the board will say, gosh, what a waste of money. Look at that, it expired worthless. Well, it's like buying fire insurance. You're not happy. You say, oh, because my house didn't burn down, I shouldn't have bought fire insurance. It has to, all this goes back to governance. This is my point. You got to get back to the board and make sure they get it. If this happens, are you okay? So you, the manager, should not be the only one who is at risk. The board should be at risk too. The board should not just be there to get together, you know, 4 times a year and play a couple of rounds of golf and shoot the breeze. They should be accountable. And that's what's crucial about these undertakings. I'm having this very same discussion internally about hedging the price of oil. And because we haven't hedged it in the past, people are uncomfortable. So my approach has been, okay, guys, you don't want to hedge the price of oil. Please don't come back to me, because in the month of between November and December, oil dropped 40%. And you should have seen what people were doing. They were running around, you know, and they all needed a pair, you know, a new pair of shorts, you know, pardon the expression.
You know, that governance issue, right? It really, I think about what are you trying to accomplish, right? You're trying to minimize the risk of disappointment. And disappointment is not the same thing for every household or every institution, or right? I mean, it really is kind of, you know, a little bit more specific, and you have to be really honest and specific about what is disappointment for us. Does it mean not being able to fund those charitable programs? Does it mean not being able to build that, new library? Does it mean, not being able to pay our beneficiaries? And so, then that guides you to making kind of the risk choices that are more appropriate for your specific situation. And I really wish people would, abandon the idea that institutional investing should be a spectator sport or a competitive sport, because people don't have the same risk tolerances. They don't take the same risks, right? And to look at, return numbers without kind of a holistic appreciation for what it's for is just idiotic, right? so anyway.
And
yeah.
we have probably one more.
Challenge is trying to figure out what you're trying to accomplish for your organization.
Absolutely.
The universal challenge. One more question, and yeah.
Benjamin Levy, co-founder of Bootstrap Lab, early stage venture capital firm. I've heard some of you form opinions about healthcare as a macro, sector that you're really excited about. I haven't heard anyone talking about artificial intelligence and how that's impacting potentially their public holdings, large corporations. $13 trillion of wealth is predicted to be either created or reallocated to different assets. How are you thinking about that?
Yeah, I'll just jump in. I mean, it's integral, right? I mean, and it's part of, the massive, the volume of change happening in so many different disciplines and domains, and the intersection of all that is what, is breathtaking and fabulous, and also incredibly difficult to, forecast how it will all play out. But AI is a piece, right? I mean, so if you think about the idea of capturing more data, right? We need more data, we're gonna get more data, sensors everywhere. That then enables the utilization of AI and ML and, and so forth, to then drive automation and then drive more like robotics, right? And so it's a piece. And so if I think about specifically in healthcare, there's a company that we have some exposure to, which is actually super cool in that it's the first AI driven diagnostic company that got FDA approval last year, and it's going live. And what it does, it's called IDX, and it does kind of retinal scans for detecting blindness related to diabetes, right? I mean, how cool is that? Because now you've got a technology that can radically reduce the cost, increase the accessibility, right, of the diagnosis without any involvement of a doctor. And so, that's good for society ultimately. And that's one example, but it's just like the very beginning. But I think AI it's just going to be integral to not just healthcare, but pretty much everything.
A shift to consumerism.
Your observation that AI is everywhere or is changing and is disruptive to everything.
It's just
for us at least has translated into why we have such a large exposure to venture, which is our venture portfolio is largely technology oriented. Over the last handful of years, it's gotten very much more concentrated in applications of AI and ML across all industry sectors. So, I mean, that's where the real disruption is beginning to bubble up into every industry. So.
Right. But it's important not to get too caught up in the hype too, right? Because
Sure.
we have data set limitations still,
Yeah.
right? And we're gonna, and you still need human beings to exercise creative thinking, right? And to ask the right questions. And so, it's a long.
There'll be an app for that soon.
Yeah.
All right, what's that?
I was going to do we have time? Or are you going to? So one sobering thought just to add. Tina's absolutely right. I mean, there are amazing things across all industries that AI is doing in healthcare. AI is enabling you to really refine and segment patient populations and specific types of diseases. You don't have to attack a monolithic disease all at once and come up with a silver bullet. You can really figure out specific medicines for specific type of patients. And that's just one example in one industry. The scary thought of AI, though, is that AI means different things to different people. It really, at its heart, means like machine learning. You're using the data to help the machine learn itself. It's not algorithms in programming. It is the machine and the data learning on itself. So the scary thing about it is that there becomes a factor where the data becomes a self-fulfilling prophecy that only a big company with an ever-expanding set of data is ever going to be able to get ahead in AI. So there's been recent discussion over the last couple of weeks, months, about some of these companies becoming too powerful, Google, Amazon, et cetera. The only way to really get ahead in AI is to support these big, giant companies. And as a country, we have a disadvantage relative to other companies, particularly China, that have less restrictive rules on personal freedoms and access to information. It's just easier to get the data there.
I'd like to disagree on this point, and it's a very important point. So, AI is a variant of intuition, and if you think about it, the more machine learning you have, the more sort of data processing, and big data is just insights, which is just a lot more. You've always had numbers, you haven't just been able to crunch them as much. But I would actually argue that in the future, smaller mid-scale companies will have an advantage. I work in a very large company. Now, I don't work for Google, obviously, so I work for an oil and gas company, which means it's more traditional. But I suspect that mid-sized companies will have an advantage. And if they do, if I'm right, if they do, then large companies will get obliterated. Because think about it, working in a smaller company where you know the people and they know you, there's less of a bureaucracy. There's less process people. There are fewer gatekeepers. If it's correct that these people can access machine learning and improve the capacity of the algorithm to learn itself, and you don't need to be in a monster company, then you're going to have a whole swath of companies that are going to go out of business.
So you don't think big data in and of itself is an increasingly competitive advantage in artificial intelligence?
It is, but I don't think you need to be in a big company. I think you can be in a medium-sized company, and because computing power and access to numbers and ability to crunch the numbers, the cost has gone down so dramatically that it's not just restricted to...
At current rates, do you think there's any other company that could compete with Amazon in terms of having proprietary data?
So that's a good point. But I think if you look at how Amazon operates, they have a lot of smaller groups within them, and they're actually done a good job at managing, giving them the ability to operate. But I'm not sure that they can just grow at the same rate as they have. Nor do I think that Google can continue to expand at the same rate. We'll see.
All right, well, with that, we are out of time. Please join me in thanking the panelists. Thank you.